Today, the Wharton professor, Jeremy Siegel, he is a noted bull. However, now he says he's a little worried. Professor, good to see you. Anytime a bull like you says they're a little worried, I need to talk to you. What's up?
Well, I'm not worried yet, Scott. I still think we're in a strong bull market, but I think interest rates and inflation are going to rise well above what the Fed has projected. We're going to have a strong inflationary year, I think 4 to 5%. The Fed is going to have to hike sooner than certainly the crazy dot plot that it put out last month. But in the meantime, enjoy this ride. It's going to keep on going.
Well, for how long? For how long? How long does it go?
I mean, I can see it, I could see it toward the end of the year. Because even though interest rates go up, if inflation goes up more, it still pays to borrow, right? I mean, 3% borrowing shouldn't be scary if you have 4% inflation. So, you're still going to gain by that sort of borrowing. But eventually the Fed is just going to have to step in and say, wow, we're just having a little bit too much inflation. And that's the time to be cautious. I would not really be cautious right now. I still think bull market is on for 2021.
Well, okay. So, Josh, the professor says you got 8 months now to let this run, let it ride, Josh Brown, and then, you can worry about it later, but certainly not now. You agree with the professor?
Man, the professor is one of my all-time favorites. Jeremy, so good to see you. So let me throw this out to you. Yeah. Let me throw this out to you. I'm curious what your thoughts are. Arguably, there's going to be a moment this year where the Fed they won't use the word taper, but they have to state the obvious, which is there is absolutely no reason for them to be buying tens of billions of dollars worth of financial instruments every month.
Agreed, completely.
We don't have liquidity issues anywhere in the system, and none of that is going to put waiters back at their jobs. Like, I don't care how many AAA rated corporate bonds you buy, none of that's going to put people back to work. So we all know that, and that'll be before we talk about rate hikes. So the question is, isn't that the buying up? If that produces a 10 or 15% tremor in the S&P, isn't that like a classic buying opportunity? Like, isn't that what you want to have happen?
Josh,
that
I
moment?
don't think it will. I mean, really, just stopping the buying while the economy is so super strong, and look at the pricing power that corporations are going to have, and people are going to say, yeah, so they stop buying. I mean, is that where am I going to put? It's again, where am I going to put my money? Long-term bonds become even worse. Yeah. Cash is going to depreciate. You've got to be real assets. Got to be real estate or stocks. They're both real assets. And you're going to turn around and say, okay, they're tapering, but where am I going?
But right now, what you're saying is, I mean, I've heard people this week throw out Goldilocks, Professor, and they talk about the liquidity in the market. There's cash on the sidelines. There's pent-up demand. There's earnings expectations which continue to go up. The Fed's not doing anything anytime soon. You agree with that?
Nothing soon. I mean, they're, honestly, Powell is playing the game with Biden now because he wants to be renominated February of next year. And I think there's a game here. That's why he's being so compliant. I do think the Fed recognizes the danger, but we have to think about Biden going to reappoint. And I think he wants that job. And once he gets that job for another 4 years, he could be much tougher on inflation.
Oh, come